So thanks for joining the conference today. So this is the second week of our VC analyst course. We have in this week we covered market analysis and competitor analysis. Um, just curious if you have any questions with regards to the content of the this week of the last week, and or if you have some other questions regarding more general topics about negotiations with VCs, fundraising, feel free to ask. A short, like in short, competitor analysis is market analysis and competitor analysis are pretty uh, important topics, and typically founders spend a lot of time on this one, and investors pay a lot of attention to those topics. So this is why I pay a stress on this one heavily. So feel free to raise your hands and ask questions. Yes, Saransh, you can
Hi,
talk now.
Dennis. Yeah.
Hi.
Hi, Dennis. Thank you for for this conversation. I was actually going through the investment memo for Twitch in this case, and I just wanted for all the structure of the information and how it has been structured and how it has been put and the research that has gone. I'm able to understand certain stuff, but there's when it comes to financial analysis and projections, that is that one section where things go where I'm not able to get a grasp of things. What are those financial concepts that gets into the deal analysis part of it. So if you can expand on how using Twitch example, we using financial modeling and projections and the analysis to come to the conclusion what Besame Venture Partners came to. That is one. And second question would be that the investment round was for about $18 million in this case, of which Besame was putting in $13 million. So I'm assuming that it was the lead investor in this case. So how
Yes.
did Besame Ventures partners came on to this number? Is there some logic to this number? How did they arrive at this number? Whether 13 or $18 million is this what this startup is going to need? So how did they arrive? So these two questions.
Let's first talk about the last question. So
Yeah.
typically in a round, like you grant about 18, 20, 25% of the companies. This is one.
Yeah.
And the other thing is so it's like the overall size of the round. And the other thing which is important is how much what's the request for the money from the
Hmm.
startup, and
Yeah.
how they reasonably spend it. Because on one hand, you don't want to get overinvested. Why?
Okay. Yeah.
Because like VC money are pretty pricey. So if you
Yeah.
get like too much money before you really need it, so it means you get additional dilution. But on the other
Oh yeah.
hand,
Yeah.
you
Hmm.
don't want to get underinvested.
Hmm.
So the 20 or 80 million, $18 million round was somewhere in
Hmm.
this range. So in the case of Twitch, there was also a $20 million transaction of selling Justin TV.
Hmm.
Because and it could bring $20 million. So I believe that this deal was structured in a way that it didn't. It suggested that you wouldn't get this deal done. So a $20 million investment from the selling of the business was like
Hmm.
nice, would be a nice surprise. But the average deal was happening, given that the cash in is what the company got from investment. Then how they landed on this $13 million which they wanted to invest. So
Hmm.
essentially, it's more like you know their internal. internal desire, how much they could to put in. So typically, if you're a lead investor, you need to like take not less than 50% of the round. So in this case, it would be about $9 million, $10 million. So and then
Yeah.
you decide and you decide typically on one hand you as a VC have intent to invest a lot of money. Like
Yeah.
if you have a good deal, you want to invest more just because it gives you positive returns. But if you have some uncertainty and concerns, then probably you will invest a little bit less and do a follow-on investment on the next round. So
Okay.
it's not a strict formula how they landed on $13 million. It was more like internal conversations which they had and their willingness to put money in. So
Mm.
that's how they
Mm.
landed on this number.
Yeah.
Uh, so this is
Okay. Got it.
also it's also the question like how much money they wanted to the team to
Mm.
gather from follower investors, so that they weren't in
Yeah.
this round alone because they wanted some other people to have skin in the game. So
Okay.
uh, that's what about it. Do you have any questions about this one?
A follow-up question to that would be, so let's say Bessemer was leading the round. So is this the responsibility of Bessemer to find other investors, to find
It's
co-investors for
no,
Twitch for
it's
this
not.
round?
No.
Mm.
Founders typically find those investors themselves.
Correct. Mm. Okay.
Okay, so then we're going through. Um, we're talking about these metrics, right?
Yeah. The financial analysis and projection. What kind of metrics were used, or what kind of financial analysis was done to arrive at this conclusion by the investment team?
So let's look. I've read it a couple of years ago. So let's look at what they. So essentially, typically the founders they send
Mm.
their financial model, their actual
Okay.
data, and like unit economics and some additional cohort analysis or some additional information, which helps
Mm.
to crunch the number and understand that financial model is reasonable. And
Okay.
what
Okay.
essentially you do, you have a financial model, you have some projections on the how much you earn per client, per click, per view,
Mm.
and then you also do a reasonable assessment how fast it will be growing, and you put those assumptions in the financial model. So first of all, the company does this financial model, and investors they look into the financial model and
Yeah.
stress those assumptions. So.
Okay.
Uh, so essentially, what we see here is monthly unique user average growth is 9.6%, and the
Mm.
minutes watched monthly by 16%. So these are the metrics which, first of all, say this one 9.6 depicts the growth, while minutes watched per month shows the involvement. So
Yeah.
it says that the numbers of minutes watched grows faster than the number of users, so involvement grows. So this is a good signal. And the average the users visit watch 75 minutes. So these are the information. This is the information they get from the logs of provided by the company. And then
Okay.
monthly unique visa users, it's the they look into the profiles which log in monthly and visit website or do some key action, and this is the information provided by the company, and
Okay.
exactly from the same database they understand that's 40% from the United States and 40 from the Western Europe and 20 in Asia. So these are like high level numbers which give a little bit understanding of how the user base looks. Then
Monetization, I guess, of those
yes,
users.
so when we talk
Hmm.
about net revenue,
Yeah.
uh, so especially for the business models like marketplaces or other business models where you are a transactional agent. So net revenue means like the GMV, the overall revenue minus the payouts which you do for someone. So for example, in case
Hmm.
of Twitch, you have streamers and you pay something to streamers, right? So net
Yeah.
revenue is the revenue you get from the advertising minus the money you pay to the streamers. So and these are the basic calculations which they had in their financial model, and they showed that this net revenue growing was growing from 635 to 670 over 3 months. So this is what and they claim to be on a run rate to 1 million in June. So what they are saying run rate, it means that this number 670 k will grow to 1 million in June 20 for 2020 like 2020
Okay.
2012. And they say that look, it seems like a steep growth, so they explain so this will happen because of this contract. But
Okay. Okay.
they also say that yeah, these are the numbers based on the information provided by the investor, by the company, but they will stress test it. Then
Okay.
they say that like since CBSI will be one of the major clients, then and which dramatically affects the net revenue. So they talked to them to understand like advertising, like what will be the pricing for the advertising and why they want to pay premium advertising costs, which is like higher than typical sports content. And these are the numbers which they get from the conversation. So,
Okay.
uh,
Okay.
so these are like typical CPMs as a typical metric for advertising businesses. And
Okay.
then
And
here,
these are the numbers. Yeah. Oh, so
yeah, go
these are
ahead.
the numbers that the investor sourced from the company CBSI in this case by talking to them, and then they put this number into the financial model to arrive at that 1 million
So
revenue.
first of all, they looked into the financial model.
Okay.
They saw those assumptions which were done by the company, by the startup,
Company. Okay. Yeah.
and then they stress tested those. So they looked at some numbers which looked a little bit high for them, and then they
Yeah.
talked to like the major client in this case, which was bringing in a significant revenue
Yeah.
growth. So
Var
they
klasını
asked,
görüyor. Bitirmiş. Evet,
yeah,
bitirmiş.
Benjamin, could you switch off for a while? Yeah. Uh, yeah. So and then they stress
Got it.
tested it. Yeah, and then they here they explain the logic
Got it.
why those rates are higher than
Mm.
the average UGC content.
Understood.
Any questions on the here so far?
It's clear now. Thanks,
Mhm.
Dennis. I
Thank
think
you.
I'm getting more clarity now on this one.
Great. Thanks for asking. Um, does any of you have any other questions with regards to the case, to the materials, or some other things?
Yeah, hi, this is James Harris. I have a question regarding the founder experience. This guy is a first-time CEO, because we know VC always look very closely at the team. So this is where, the people equation, forget the numbers. What about these people? So if you can elaborate on looking at the people, the why you would
Okay.
accept some people, not other people.
Okay, so this deal is not usual. So first of all, CTO becomes CEO. Like he was like the first time founder, and he was chief technology officer. Becoming chief executive officer is not an easy transition, like generally speaking. And more importantly, this deal is essentially a pivot. So the initial company was just in TV and raised like 6 million or so, and it didn't work out that well. So this is why they are selling this business, because it's not growing crazy. So they launched Twitch as a pivot, and it started to grow. And also there was another company which pivoted from this business, and kind of a team was falling apart. I mean, like the main co-founders, they were leaving the company, and this is a really unusual deal in this sense, just because like many things could go wrong. And when they talked, they had a lot of talks, to be honest, like with this founder becoming CEO. So, and they, after those talks, they decided, yeah, like we have a gut feeling that this guy could deliver. But essentially, it's not an easy deal to do, to be honest, like because there are several things which are unusual. So the first is company breaking apart, then they're doing a pivot, then they're selling a business, part of the business, and they also compete against YouTube and some other and some other company. So yeah, so it's not unusual deal. Another interesting moment about this deal is essentially the valuation. You remember that post-money valuation was 53 million, but in the text they also say that there is another fund which gives a lead term sheet with a valuation of 90 million, almost twice as high as Twitch does, as Bessemer does. So the question is like why they are open and Bessemer says that they are pretty sure that the team will go with them instead of that term sheet with higher valuation. Do you have any ideas why is that?
That's very strange. Yeah, I don't know why.
Okay. Any ideas? Yes, Saransh, go ahead.
Could be, and I'm shooting some blanks here in this one. Could be some outright strategic acquisition. So usually for a big company to do a strategic acquisition, they would usually pay a lot to get a
Mhm.
company if it fits their business model.
Mhm. Okay, this is a good idea. Unfortunately, we don't have enough information to check if you are right or not. But I believe it was another case. It was not a strategic acquisition. It was because otherwise they would say so. It was a financial investor. So, do you have any ideas why a financial investor would like to pay more and where and founders not taking this deal?
So you say a financial investor was willing to pay them more,
Mm-hmm.
and the founders were not buying into this idea. I'm suspecting the financial investor must be seeing something very valuable with the company. Whatever the content that they were creating or whatever the engine that they were producing for social media in this case. So I'm suspecting something of in the future that they were suspecting that this company or its asset would be very valuable in the future. Could be that.
Cool. Um, to be honest, the most basic scenario is that Bessemer had a more strong brand, while the other financial investor was like less experienced or weird, whatever it is. So they didn't have chemistry. They didn't believe they could bring a lot to the table. I'm not sure, like no information in the text. So this is the first thing which comes to my mind, that the other financial investor was not that as good as an investor, because investors in the round are also a signal to the market.
Okay.
So
Okay.
having a better investor is better. The other
Okay.
aspect is like if you don't have a chemistry and if you don't like people you're making deal with, uh, it could, or you see the signs they could be irrational on the boards of directors. So this is why you're not taking those money. And the third thing is valuation is not the only parameter founders should look into, because investors have many other instruments like participating liquidation preference, for example, to protect to have downside protection. So people can give you high valuation, but it will work only if you have a good exit. For example, you can sell
Okay.
a company for 100 millions of dollars and get nothing as a founder
Yeah.
if
Yeah.
their own financial instruments are part of the deal. So I believe it was the combination of the two parameters. And first, the most important was that the other VC didn't have a strong brand. So this is why they like given that they knew who was the investor, Bessemer was sure that we would prefer taking money from them, from Bessemer instead of the competitive term sheet. And the other thing was the overall dynamics which they had talking to VCs, like to the founders, so
Yeah.
that they felt like so that they want to do this deal anyway. So this is a
Sure.
combination, like as with any negotiation, sophisticated negotiation. This probably was the case. Okay, but
Understood. Yeah. Yeah.
it's a good question. Thank you for bringing it up. Um, okay, and speaking of this case, I'm also curious, like so first of all, they've been building kind of a new category, right? Streaming for games for gamers. And there are several questions I have. So the first question is why they believed that how they persuaded themselves that this business will take off. So what proxies they used to understand that, yeah, users will like that. Do you remember they are talking about how they participate, how the partner participated in a esports offline event in South Korea? There is even a picture. Look, there is even a picture. Yeah, give me a second. There is even a picture in the yeah this one. So he told that, yeah, I know I was on a tournament and it was crazy, like people watching others playing and screaming and praising them. And it was like the first thing. The other thing, the other thing they paid attention to was this gaming play, like they referred a TV show where people played where participants played on the video in poker, and millions of people were watching this show. So this is how they proved that, like persuaded themselves that um, that people like to watch other people playing games. Did I like explain it clear?
Yeah, to me, it was clear. A question to that would be, Dennis. So, when the company sort of presented this case that there is a very big market for people watching games, watching professional players play the games, how did Bessemer validated those data points? Did it run some own internal analysis or market numbers on it, or did it hire some other consultants to validate those
Typically,
numbers?
typically they do it in house, but in case of in this case didn't have like market sizing section, so they said like it's huge, period. So that's essentially how they did it in this case. But in other cases, you would do some reasonable assumptions yourself and say,
Yeah.
well, it seems like a pretty big market. There are a couple of questions more I wanted to focus your attention on. So the first is, you remember that uh, there are uh, game producers, right? Like game studios. And when you stream a game, like people are how watching the game, right? And when you stream like videos, pirate content, for example, the publishers, they're really crazy about it. Like they sue you, and they sue you, and they forbid someone, especially third party platforms, to stream the content. So question is why um, gaming studios wouldn't be ruining this model. Why instead they would be supportive for the third party providers to stream how other people play. Yeah, Saransh, go ahead.
I mean, the reason that comes to my mind would be to promote the games, to create some viral moments out of the game, and then even I'm assuming that Twitch would be paying some sort of a licensing fee to the game studios as well of showcasing their games to a live audience on that. So these two reasons.
Mhm. So it was like, yeah, in general, you're right. So mainly, the main point here is that games is as they call it, is not a linear content. So when you watch a movie, you watch the movie, that's it. Sometimes you can watch it second or third time, but you wouldn't be watching it every day, right? So this is why content like IP owners are so harsh on pirate content. But when it comes to games, uh, it's a non-linear content. It means that you, as a user, you enjoy the game when you play it yourself. And when you watch someone else to play the game, it's not the same experience. So when you watch someone playing the game, you like kind of want to see to do it yourself. So people who watch others playing the game, then they go and buy the game for themselves to play. So this is why it looks like an advertising more more like an advertising than the pirate content. So this is why they believed that uh, that uh, that wouldn't be an issue. Another question is, it's in the case it was mentioned that some companies, some game producers, they have built in house those streaming platforms for their games. And the question here is why big gaming studios wouldn't build their content, their streaming platforms instead, and let third-party providers to earn on their content. So if you can, you have fans, okay, you have games, you stream it, you take all the advantages of streaming the game. So why third party player like Twitch? It's essentially very important because it helps to understand how VCs think. Okay, you have a game producer, and the game producer only has the audience who already play in those games. But you, as a user, you you'd like to play the games you like. It's not that you play the games produced by a given studio. So the third party, so if you're a game studio, you would be promoting only the games that you produced. But it's not guaranteed that you produced all of your games are the best games people would like to watch. So if every game producer would build their own platform, they wouldn't add other games on the platforms. So they like kind of every of them will be reinventing the wheel. While if there is a third party platform, they don't have a conflict of interest. They can stream any game which is the most popular among the users. And here where the network effect starts to work, because you come to the platform of Twitch and you're sure that you will see the championship on the best games ever available on the market with the best players. And you, as a streamer, you know that you get the best, the biggest, the most involved audience when you stream. When you stream on Twitch versus the lock being locked on a certain platform of EA Sports, for example. So this is why place for Twitch. There is a place for Twitch. Okay, and the other question is okay, they competed against YouTube, right? So there was another standalone solution, and there was YouTube, and YouTube was going to launch media for streaming for games. So why didn't how they persuaded themselves so that they could play against YouTube in this case? So they went and talked to people from YouTube, and they got like employees, and they got a perception that YouTube was not moving that fast with this solution. And there was another thing that despite they launched the YouTube games, in general, for YouTube it was only 10% of the audience, while for Twitch it was 100% of the audience. So Twitch was more focused on building a holistic product for streamers than YouTube, which was building like a more general product. So this is why they were like less cautious about competing directly with YouTube. Okay. Okay, that was the case. Any other questions regarding the case? Yeah, and the last thing I wanted to show you is about the returns, the potential returns they get. Okay, so at the very end, yeah, this they have this financial model. This is this table. Do you have any idea how they calculated those weights of probabilities of 15, 20%, and the returns and IRRs? Oh. So they did a scenario analysis saying like, okay, we write down the company, this we sell it for 30 million, 70 million, 75 million, 240 million, 500 million, and a billion and 25 250 million. So it's just like various scenarios depending on the revenue the company will get. Then they have like the dates when exit date would be, and the bigger the company, the later the date, right? So a writing of the company will happen in 2 years. It means they spend all the money and get nowhere. So they write it off. Selling in September. It's like for 30 million. It means they will be losing money. It was okay. We are kind of selling the company, but it's like we invested 2 million. They didn't raise another funding, so we just selling it as we can. Then they have this 75 million sales. So it's saying essentially like the entry. So they invest at 53 million pre-money. So selling for 75 and investing like 18 million. So it essentially means that they return all more or less the money they invested in, given the 2 years of interests. And then they have this like mid-positive scenario of selling the company for 200 million something, 500 million something, and a billion something. So first of all, like, do you have any ideas how they came up with those probability scenarios? Like 15%, right, in of 20% no growth, 30% slow growth, and 20% of high growth, 12 of market leader, and 3% of like the best scenario.
They used average return for this business and then calculated the high, low, max, and medium. Just my
So
guessing here.
it's more like they looked at their portfolio and they have those probabilities, historical probabilities, given the stage of the company, which they saw across the previous investments and across balanced it probably with some numbers like market numbers. But essentially, if you look at the other Bessemer memos, you will see like exactly the same table, and those numbers are more or less the same. It means that they have in-house a methodology which requires them to build those 6 scenarios and the probability of success. So it's just like the internal mathematic model, which the table they need to fill in. So this is how they do that, and
So
then
does,
uh-huh.
sorry, does every VC firm have their own model, or do they use like a standard model, or is it based on their
Everyone
experience?
adjusts according to their needs, so it's not like a market standards. But more or less, the logic is the following: you reasonably assume like what's the chance of the scenario, reasonably assume the exit value, the exit time. You reasonably assume the exit value and the portion which you get from it, and then you calculate IRR and then calculates weighted IRR. Okay.
Yeah, thank you. Thank
Mhm.
Then
Great.
they might,
Yeah, go ahead.
yeah, they might have also checked the deal term or the ownership, like what would be the, I mean, the cap table, etc. For this financial modeling then.
Could you repeat your question?
So, so no, normally VCs would also stress test, right? So depending upon the cap table, they would like to predict the model also for the probability.
So look, so how they embraced this cap table calculations. So you see gross proceeds.
Hmm.
So gross proceeds is it's calculated. Mary, 5 minutes. Mary, 5 minutes. So so how they calculated it? They took this exit value. Then they multiplied by the share of the company, like Bessemer holds. It was 18%. And then they look into the terms, because in the case of Bessemer, when you look at the terms, they have liquidation preferences, 3x, 3 point. So, oh no, I don't. It's not easy to find. Yeah, but they had three. Okay, 3x probably that way. Yeah, no. Yeah, so the 3x cap. So they have there is this calculation like so they have like 18% ownership and participation liquidation preference. So they apply those terms how they would work in case of the deal given like the company was sold at this scenario, and they calculate what would the gross proceeds which they as a fund will get.
Hmm.
And you see, like in case of wiped out, they get nothing. In
Yep.
case of selling for 30 million, they get 13 like 13 million, and 13 million is more than 13.9 million is more than then like if you multiply 30 million by 18% is 6 million, but they get 13. It's
Yeah.
just because of this participating liquidation preference.
Yeah. Yeah.
And here they also get a little bit more because of in case of 75 million sales, they get a little bit more than 80%, 18% of the company because of the participating liquidating preference. And in the later stage, they get like they sell for 40, they get 43 million. It's about 18%. If they sell for 550, they get about 100 million. So it's about 18%. And for this one, they get even smaller. Why? Because they expect that in those best scenarios, they will have one more round of investments and their share will be diluted.
Hmm.
So sometimes you do suggestions that you will have another round, you will get a 20% dilution. So you multiply your 18% by 0.8, for example, for the suggested dilution of the next round, and you land on another number.
Yep.
Okay.
Yeah, but thank you
Yes.
so much.
Yeah, I hope that it will be clear. Okay, I believe we can finish with this case. Thanks everyone for participating and asking questions. Do you have any other questions? Yeah, Saranj, go ahead.
So Dennis, not a question. We can reach out to you on WhatsApp on sort of seeking some advice on any of the subject matters regarding
Yeah, you
VC.
can. Yeah, you can reach out to me via WhatsApp. Sorry, I'm not answering always fast, but you can ping me like a couple of times and I will answer to you because like the last couple of weeks were like kind of travel, etc. for me. Yeah, but like just ping me explaining that you're participating in my course and you need my guidance. Yeah, and we will decide how we can work on that.
Sure, I'll do that. I'll repin you again.
Okay. Any other questions today? Yeah, if you don't have any other questions, uh, then we can wrap it up for today. And we have one more week left. I believe we won't do this case of we won't do the case of Latin America market. So I'll send you just a few videos and you will watch it and and I'll answer to the questions and that will be it. Okay. Right. So thanks everyone for joining today and yeah, see you next week the same time. Have a great day. Bye bye.